Session this afternoon. We'll get started whenever you're ready.
Thanks, Bill. So we wanted to come in today to talk with you a little bit about, and frankly make a recommendation to kind of follow up on our conversation that we had regarding Sovereign Asset Management, which currently manages a bit over $15 million, almost $16 million of their portfolio. And I just wanted to kind of summarize how we got here. So the changes that are occurring with Sovereign. So the strategy that we use with them is a dividend strategy. In order to hold a position in their portfolio, the stock must have increased their dividends every year over the last 5 years at a minimum. They look at some other things as well, but that's a must. That strategy is actually being sold to another investment firm. And Logan, for some reason I can't keep that name in my mind. Logan Capital, which is actually down in Philly. And so our back office down at Stiefel in St. Louis, as we do with all of our money managers, they do a lot of due diligence to kind of see forward-looking, what's the management team going to look like, what's the performance been, what's the succession plan if a manager would leave. There's a lot of criteria. And one of the things that kind of raised a little bit of a red flag with this strategy moving to another firm is that our back office found out that they only signed a 1-year contract. And that's kind of unusual for that to happen, so it's kind of raised a red flag. And when we heard that, it kind of gave us the opportunity to start looking at what are the other alternatives out there with a similar strategy, because we like this strategy for the pension plan. As with all of our managers, we try to be a little bit defensive and protective. We want to protect you on the downside and get as much as we can on the upside, but protect it on the downside. So this particular strategy really fits the bill and makes a lot of sense. Generally, usually large cap value stocks, usually with low debt on their balance sheets, and these folks here will talk to that, I'm sure. So that's kind of how we got here. We talked about this probably starting back in October, and we've spent some time doing that. So we're actually here, Brett, Holland, and Sonia and myself are here to actually make the recommendation that we move from Sovereign and actually turn those assets over to a firm, Dearborn Partners, based out of Chicago. And we have two representatives here. We have Brian Payne, who's the Director of Client Relationships, and Michael Edlin, who's a managing director as well as a co-portfolio manager. So Mike can speak specifically to the management of the portfolio. And we just thought it'd be a good idea to have them come in. We vetted them already. We feel very comfortable with them, but give you guys a chance to ask some questions and learn more about the ones that you probably don't know about.
Okay. Sounds good.
Great. Well, thank you. Yeah, thank you for the opportunity to be here today, and great to meet you guys. So my name is Mike Andelin, Dearborn Partners. I'm a portfolio manager on this strategy specifically. I've been with the firm since 2004. I'll give you a little background of Dearborn Partners first if you're unfamiliar with us. And there's a slide deck here, and you can go through these one by one, and any questions along the way, please feel free to ask. Open discussion is the way we like this. Dearborn was founded in 1997, around 21 years. We have 25 employees, primarily in Chicago. We manage about $4.3 billion in assets. That's a variety of private clients, pension funds, and retail investors. About $3 billion of that strategy is in this rising dividend strategy that we're here to talk about today. In 2011, a woman by the name of Carol Lippman joined our firm. She actually started this strategy at a firm that was then known as A.G. Edwards. I don't know if you're familiar with A.G. Edwards, but they were bought by Wachovia and then folded into Wells Fargo. So she joined us in 2011. We launched the strategy at Dearborn at that point, so we've been running this for 7 years at Dearborn Partners. The strategy was actually launched in the early 90s. So when Mike talks about worried about a one-year contract and things of that nature, Carol, myself, and John Rick Seitz are actually the owners of Dearborn Partners. So there's no concerns of anyone leaving anytime soon. So, couple quotes here. I believe non-dividend paying stocks aren't much more than baseball cards. They are worth what you can convince someone to pay for them. Mark Cuban. And then rising cash dividends are tangible evidence that companies are doing things well. And that's really kind of how we view the stocks that we buy in the overall market. We're looking for companies that are willing to share part of their profits with you on an ongoing basis. And we're looking for those profits increasing year over year, and again, those dividend payments to the end shareholders increasing year over year. Our investment team, on the next slide, I mentioned Carol. Carol and I are co-portfolio managers on the strategy. Another portfolio manager, Pete Dekas, and then 2 analysts. We spend 100% of our time finding high-quality stocks that pay dividends, names, companies that we think can increase their dividend year after year. This is a very conservative equity strategy. Very similar to what the fund is invested in for the strategy at Sovereign. We're focusing on the highest quality companies. I'll get into some details of what we look for. But just to kind of take a step back, we hold up very well in choppy markets. As you know, the stock market's done very well since the bottom in March of '09. We've had periods here of very low volatility in the market, just kind of creeping up and up little by little here each month, until about 8 weeks ago, where the markets had some chop here. This is kind of where these types of strategies shine, and where we're really tested. The stocks that we hold are of very high quality nature, low debt on their balance sheet. Many of them have no debt on their balance sheet. And they've been through tough times before, recessions, slowdowns in the economy, which is really the worry right now in the overall stock market if you follow the news or turn on CNBC at any point. So these companies have been through it before. Many of these names have increased their dividends 10, 20, 30, some of them more than 50 years in a row. So they've been through recessions, they've been through tough times. These are names like Coca-Cola. You pay 50 cents for a Coke, and there's some inflation, you're likely to pay 55 cents for a Coke next year. It's those types of names where high brand loyalty, really high barriers to entry for a lot of these companies as well. Over time, earnings drive stock prices. The next slide here. You can see the blue line here is the price of the overall market. The red line are the earnings. So you can just kind of see over time. We're looking for companies that are increasing their earnings over time. No one can predict exactly where stocks are going to go, but generally speaking, stock prices follow earnings. And the trend here recently has been earnings have been increasing quite nicely. So we've been quite pleased with what we've seen out of the companies in our portfolios. Earnings growth this year is going to be north of 20%. We haven't had this growth rate in a long time. Next year, just so you know, the forecast next year is for 8 or 9% earnings growth. So while things may have slowed a bit, the tax cuts this year that we experienced in lowering of the corporate tax rate has helped a lot of these companies, but we're still looking at decent earnings growth for next year. So overall, with this pullback we've seen in the market the last 8 weeks, we're optimistic on where we can go next year and beyond for this portfolio and for the overall market. Returns of S&P 500 stocks by dividend policy. Kind of a busy chart here, but I'll just kind of walk you through this. The top line are the names that we're focusing on. These are kind of an aggregate of the stocks that have increased their dividends over time, year after year. And you get an excess return in those names that can increase their dividend year over year, about a 10% annualized return. The other categories below are names that pay dividends but don't increase. The overall market, the S&P 500, and then the bottom 2 lines are non-dividend paying stocks and stocks that cut their dividends. So you can see the difference over time. Again, this is a 50-year chart of the overall market in these different categories, but the returns are quite amazing when you look at the dividend cutters and the eliminators versus the dividend growers. So what we look for in companies, I mentioned a couple of these points: market leadership with high barriers to entry, solid financial condition with very strong balance sheets. When we look at a company we'd like to add to our universe of names that we follow, we go right to the balance sheet. What are its debt levels? If they do have debt, it's investment grade debt, no junk bonds in our portfolio, companies that have junk bonds. Dividends well covered by cash flow and earnings. So companies paying, let's say a certain percentage of their profits to you, you don't want them to pay too much of their profits to you in the form of a dividend, because if there's a slowdown, it's harder for them to grow that dividend over time. And people think companies that pay dividends are just pure value stocks. We also have a growth component to our portfolio. So there are names in the portfolio that are growing their revenues double digits versus Coca-Cola that may only grow their revenues 4 or 5%. There's a nice variety of value and growth companies in the portfolio. And you might mention there's large cap stocks in the portfolio, the largest out there, and then also mid cap stocks. So some medium sized companies that are growing quite nicely that we hope to grow into mid caps or large caps over time. So we're looking for companies over $1 billion in market cap. We consider kind of mid-sized companies $1 billion to about $20 billion, and then large cap companies $20 billion on up. Each of these stocks in the portfolio pay at least a 1% dividend. Very low leverage, low levels of debt, as I mentioned. This gets us down to a list of about 150 to 200 companies that we actively look at on a quarter-by-quarter basis. Right now, that list is 182 names. In this specific portfolio we're talking about, there are 49 stocks in the portfolio and a very small cash percentage. We do bottom-up fundamental analysis on each one of these names. In order for us to feel comfortable with a company growing its dividend over time, we go through the balance sheet, we go through all the quarterly filings. We really have to feel comfortable that this company can grow over time. And we'll add it to our valuation workbook. And this is, I think, where we probably add the most value, is this proprietary valuation analysis. It's a dividend discount model on the cash flow, the dividends that a company's paying. And we come up with a low and high end range on each stock. Many of these names are over their high end, but we're not going to buy a name like that, so we wait for a company to trade off, like we've seen in the last 8 weeks, before we'd be interested in buying it. We need to buy names at the right stock price level. And we hope when we buy a name that we can hold it for 5 years plus. Very low turnover, meaning how many names are you buying and selling a year? That number is very limited. If we're going to make a move, we want to make sure it's the right move. And if we put a new name in the portfolio, we want to hold it for a long time. So it's very low turnover in the portfolio. We've actually averaged about 10% turnover since we launched this strategy. Not a lot of trading activity going on. So our core rising dividend portfolio is what we're talking about today. 49 stocks, 1 cash position. There's representation from all 11 S&P sectors. So we have energy companies, industrials, technology companies, healthcare. We target a dividend yield greater than the S&P 500. For reference, the S&P 500, the aggregate of those stocks in that index pay about a 2% dividend yield. We're currently at about a 2.5% dividend yield there. And we're looking for mid to high single-digit dividend growth out of the portfolio. And if you turn the page, this is kind of a representation of the income stream that would have been generated from a $17 million portfolio over the last 6 years. So this is the actual cash payments made from dividends from the companies held in the portfolio over, this is a 7-year period actually, which averaged 10% higher year after year. And to give you an idea, this year we would expect this number to be close to 13%. The average, 48 of our 49 stocks in the portfolio have announced a dividend increase this year, an average of just over 13%, which is the highest growth rate we've seen since we launched this. So you can see cumulative, just the dividend income alone on this portfolio would be almost $5 million. And this again does not include the stock price appreciation, the nice market that we've seen over that time. And this is all while taking less risk than the overall market. The high quality nature of these stocks in this portfolio, we're taking less risk than the overall market, the S&P 500. So we have a beta in the portfolio of 0.8. And what beta is a measure of the volatility versus the overall market. So about 20% less volatility than the overall market. So when the market goes straight up, we may not keep up exactly with the market. We're going to participate and keep up very close to the overall market. But when we hit a choppy period like we've seen lately, the portfolio holds up very well. We're being tested on that right now. I mentioned the dividend increases in the portfolio. This is through early November. In 2018 here, this year, we had 54 total dividend increases out of those 49 names. So we've actually seen multiple dividend increases out of a number of names. We're actually up to 62 dividend increases now. This was taken just a month ago. We've had companies announce multiple dividend increases this year. And again, about a 13.5% increase year over year. the line we like to finish with in our presentation is one of the best ways to make money is to not lose a lot. Number one goal is to preserve the capital in any of our client accounts, and number two, grow it. We have found that when the markets, when the going gets tough, these high-quality names hold up the best in tough markets. But at the same time, these are names that have participated in the upside of the market in the long term. We think we've done a good job doing that. We have some more data here on big down days in the market where this portfolio has outperformed. Happy to get into those, but if you think of Dearborn Partners, just like to leave with this thought is, we're a shop. Our investment philosophy has always been since 1997. High quality dividend paying names are the best way to participate in the stock market, and we truly we welcome the opportunity to work with you. If you skip ahead to page 15, you can see some periods in the last couple of years where the market has had some rough patches and how our portfolio has held up. And you can see the page 15 here, you got the S&P 500. There's a period in 15 through 16, two periods actually, where we had two 10% pullbacks, and you can see how our portfolio held up in each one of those times. And then just this recent one with the market down 11%, this portfolio is down about 7%. So again, holding up well in a rough market, and then participating on the upside as well. Any questions?
So this is part of the downside strategy, obviously. You guys are pretty close to a Warren Buffett type philosophy, is that right?
We are, for sure. In fact, this last quote in here is from Warren Buffett.
Was it?
Yeah.
Felt like it. You going for Charlie Munger's job?
I'm happy where I'm at. I'd rather live in Chicago than Omaha.
So you have $4.3 billion in assets under management. $3.1 billion of it is this.
In our rising dividend strategy, correct.
And what's the rest?
We have some family offices in Chicago we manage money for, names you would know, and then some pension funds in the Midwest. Many Taft-Hartley plans in the Midwest.
Okay.
Yep. Great.
So how'd you two get hooked up?
It's a good story, actually.
Well, actually, Sonia and I were down we have an annual meeting down at the Stifel offices in St. Louis every October. And we knew this, sovereign was happening, and Brian and I actually ran into each other, and I knew they had a dividend strategy, and we started some conversation down there. It was one that we were starting to look at anyway, but we just kind of happened to cross paths. I wasn't really seeking him out. And so we just kind of had some good conversation there. And then actually in November, I think we were starting to get more serious about making this change, and we invited these gentlemen out. So we met with them actually here in Lebanon in November. And again, like the story, I mean, Sovereign did fine, for us. Very similar strategies. I think actually one of the things I like a little bit more maybe about this particular strategy is Sovereign was so focused on, before they could start investing in a company, that company had to have a track record of 5 years of increasing dividends. Dearborn's a little bit different than that, and they also have some mid-cap companies, not big exposure, I don't know,
20%.
about 20%. Those are opportunities to start with a little smaller company that's growing and doing well for themselves. That might add a little bit of growth, as Mike had mentioned. So I think it does a lot of what Sovereign does, but I think it actually adds a little bit more than maybe Sovereign, and still gives us the downside protection, and that's always been our way with the pension. It's no surprises, no anything kind of blowing up on you if you markets are bad, they're bad, but we don't want to be as bad as the market, and that's just kind of been our philosophy with helping out with your pension.
So if 20% is mid-cap, what does the rest of the portfolio consist of?
Large cap.
80% large
Yes,
cap.
correct.
I was just going to comment one thing, Commissioner Lutz, too, is part of our research Mike mentioned earlier, too, that our back office, we have a whole department that does a lot of due diligence on all kinds of different managers. Actually, a number of years ago, they were cleaning out some different managers that were, I'll say, just kind of accumulated over a period of time, but really weren't doing what they were hired to do, so to speak. And so that due diligence department, who meets with groups like Dearborn, and we had Lake Mason in here just a few months ago, groups like that, and just to use a practical term, kind of kicking the tires, they spoke very, very highly of Dearborn as well. So that was an endorsement for Mike and Sonia and I to kind of say, hey, this is probably the right group, so.
And did they get to sample some Lebanon bologna while they were here?
You waited on the way out.
Some time here.
And then there's worse down the street.
Just need an address.
Yeah.
They even have Shuey's pretzels, so you don't have to run over to Lehman.
That's right.
You mentioned Coca-Cola
Yeah.
as an example. What are some of the other top, I guess, that you've held on to for a long time?
Yeah,
some of
sure.
your top performers?
So longtime holdings for us, really, here's some names that have been in the portfolio for the last 7 years, being Illinois Toolworks. We have, Johnson & Johnson, ExxonMobil, so some of the large cap names there. But
Could you say those companies again?
Illinois Toolworks, Johnson & Johnson, ExxonMobil, and others that you may not have heard of, Broadridge Financial. We just purchased a Sherwin-Williams, so those are a couple mid-cap names that we think will grow nicely here the next couple of years. So yeah, many long-time holdings that have increased dividends, 10, 20, 30 years, but as Mike mentioned, we don't have that hurdle of 5 out of the last 5 years or 10 out of the last 10 years of raising their dividend to get on our radar. And we think if you do that, it's a great selling point and a great marketing piece. But if there's a name that has just initiated a dividend, like 5 years ago, Apple initiated a dividend. That's a name we bought early on. If we waited 5 years for 5 consecutive dividends, you would have watched Apple's stock price go like this, and you would have liked to hold it over that time. So it's our research that we look at these companies and feel confident that they're going to continue to increase that dividend. And as long as it's trading at the right valuation, we'll buy a name like that.
Is there any, with the baby powder issue that was just in the news, is there any negatives to holding that?
There is. They're definitely watching. There's always something going on with names, and we have to be on top of that. This was not new news what came out last week, and Johnson & Johnson has $20 billion of cash. And what came out in recent weeks is not any new news there. So yeah, we have to stay on top of a lot of things with these companies. But these companies have been through issues before and gotten through it and continue to increase their dividends.
One question you haven't asked is, the cost, is there any change in cost from Sovereign? And their normal fee is 50 basis points, but they've been kind enough to kind of work with them to get their cost down to 35 basis points, which is exactly the same as Sovereign, so there'll be no cost increase
See, we didn't ask that because we assumed that they would do that.
And that's your job.
There you go.
Are all your investments like American-based?
They are. We have 2 ADRs, which actually we sold those 2 years. Over 90% of our companies are domiciled in the United States, of the ones that we follow. A couple Swiss companies that we held in the portfolio that we don't anymore, Novartis and Nestle, where primarily their operations are in the U.S., but they have a Swiss headquarters. We sold those names out earlier in the last year. So yes, all of our companies are domiciled in the U.S. We do have some international exposure in those companies, though, because about 40% of the revenues of those companies are overseas.
After further negotiations with Brian, it's actually 30 basis points.
Oh, 30.
You guys just do that over here?
I think between the 2 of them, yeah.
Well, thank you very much for coming
you.
in. Sherry, Bob, did you have something?
Sally couldn't make it today.
Oh, no, she's still recovering.
Thanks for the time.
Okay.
Thank you.
Thank you.
Thank you.